It's that time of the year again when Finance Minister Tharman Shanmugaratnam reveals the government's plans for the next fiscal year in the budget statement this Friday, 18th of February. Now, many are expecting the government to give a lot of handouts to individuals and families because of the blistering GDP growth, 14.7% last year. But are those expectations sound? We speak to a few economists to find out. Singapore's economy grew 14.7% last year, a figure that economists point to as a reasonable basis for expecting a healthy budget for fiscal year 2011. This will be unveiled on Friday the 18th in Parliament by Finance Minister Tharman Shanmugaratnam. Selina, why don't you start by telling us what do you expect generally out of the budget this year?
Okay, I think if you look at the growth environment this year, obviously it's going to be quite different from 2010. 2010, we saw phenomenal rebound of growth, going up to 14.7%. I think this year we're looking for a moderation back to sort of more like the 5% range. So obviously the concerns about, a global double dip is fading. I think people's attention is really turning more to the rising inflation theme. And, given the household numbers that we have seen generally, essentially there was a rebound in terms of median household income. But I think people are still starting to feel the pinch, from rising prices, all the way from food prices to transport, private transport, it's really from the COEs, housing prices, and even, simple things like childcare fees as well. So I think we are, in a sense, quite similar to the pre-crisis levels when, rising inflation was really on the minds of everyone, especially the men on the street. That said, if you look at the inflation headline numbers, we are expected to maybe see 4+%, approaching 5% in the first half of this year. But the likelihood of it subsiding back to below the 3% handle for the second half of the year is actually quite high, meaning that we do not get runaway inflation. We will not see inflation go all the way to 6%, which was what we saw, prior to the crisis. And I think in terms of the budget expectations, obviously, market expectations are a little bit heightened because people think that this is going to be an election year as well. And given the likelihood that last year tax revenues were very buoyant, so in terms of the fiscal surplus position, actually the government can be in a situation to be more generous in terms of special transfers and, of course, special help to help lower income families with the rising prices.
The budget of the last 2 years have been chock full of pro-business measures, and economists still expect more on that front.
In terms of corporate emphasis, I think the government will focus on the continued efforts to upgrade the productivity level of companies. So therefore, I expect some tax incentive to help the companies upgrade their technology and also their production capability. That could be assistance scheme to also upskill the labor force as well, and that will complement the productivity drive even for the companies. And also, I think there should be emphasis on helping the SMEs enlarge their presence to the regions. There could be actually tax incentive, financing schemes to help SMEs venture into the regional market. And also, I think there could be some emphasis on the green energy sector, given the emphasis that the government is trying to improve the energy efficiency in the economy. And then lastly, I think there will be continued emphasis on enhancing human capital and also in R&D and innovation.
But what about individuals and families? Given that the general election is expected sometime this year, many are calling for more to be done for households.
I think for the last 2 years, the past two budgets have focused quite a fair bit on helping companies cope with the recession. But this time around, I think it will be slightly different. This budget, the emphasis will really be on the household, and it will be all about wealth distribution. And I think the emphasis will be on the lower as well as the middle income group. For the middle income group, I expect an income tax rebate because this group tend to be the sandwich class. They have not really benefited, from some of the assistance scheme from the government, and at the same time, they have also faced some difficulties during the recession years as well. So therefore, I think income tax rebates will actually help them a lot. And for the low income group, I think we will see a whole slew of measures to help them cope with the rising cost of living. So this should come in the form of perhaps the ComCare Fund, the EduSave schemes, and also the USave scheme to help them cope with the utility charges, the rising utility charges. Perhaps there will be also some top-ups in terms of the MediSave account for the elderly to help them cope with the rising medical costs. And last but not least, I expect some cash handouts, direct cash handouts to the lower income group. These in the past have came in the form of growth dividends as well as the Singapore shares. So all in all, I think this time around we should see a package which will be quite similar to what we have seen in 2006, which is the progress package during the last election year in 2006. But except the fact that in terms of magnitude-wise, I think we will likely see a special transfer package which will double the progress package. Especially we are looking at a total of 7.2 billion Sing dollar special transfer package.
The likelihood of getting an actual, cut in the personal tax rates, frankly, I wouldn't rate that as very high. So I think in terms of the help, it would really come in the form of possibly tax rebate. And also, I think in particular for the lower income families, it can come in the scheme of, the USave, some of the top-ups into the EduSave or the MediSave kind of accounts. And of course, even an extension of like GST credits, for instance, I think those will go some way to actually easing the inflation pain for the lower income families.
So do economists think that the government will spend most or all of its surplus on pre-election goodies?
We are essentially looking at another expansionary budget. Hence, we are looking at a small deficit of about 2.2 billion Sing dollar. Just a very small deficit which accounts for probably just 0.7% of nominal GDP. Right. So all in all, the fiscal position is very comfortable to dish out a very general budget. Apart from the upside surprise from FY 2010, we are also talking about the accumulated surpluses over the last few years by the current term of government. So overall, if you add up the sums of money over the last few years, we are basically in a very good position to dish out a very big ang pao to Singaporeans this time around.
Actually, my suspicion would be that it will be a broadly neutral or balanced budget. Given that the fact that they would prefer to balance the budget for the term of government, obviously there's some room for them to be more generous in terms of the fiscal incentives this time round. But I think probably they'll be aiming for a broadly neutral fiscal position.
So although most economists expect more help for individuals and families in this year's budget, they don't expect the Singapore government to dip their hands too far deeply into the coffers. The consensus is it will probably be a projected balanced budget. But will it be? Well, join me on thestraitstimes.com for live blogging and some analysis on Friday. I'm Joanne Lee for The Straits Times, Singapore.